I'm recording this video in November of 2021. There are about 50 days left in this fine year. And if you are 72 and older and have money in an IRA or 401k or 403b, I hope you know by now that you have to do a required minimum distribution known as an RMD. This is what the government forces you to do. You may recall, because it was a long time ago, maybe you don't recall, but you put all this money in your tax-deferred account. You got a big tax deduction and that money grew all this time. Well, now, when you turn 72, the government says, hey, you got to take some money out of that account, pay some tax, because we need money. Now, it can be very confusing. So to help you, I have created a video that we will call 7 must-know, must-understand facets of the complex and easily misunderstood RMD distribution process. How's that for marketing? We will get to it in a second, but first, let me share I am Daryl Rosen. I'm the voice behind Real Retirement Advice. And the reason I created this free resource is to help people, retirees, future retirees, anybody who's even thinking about retirement, to help you create a life full of safety, simplicity, and strength. If you like what we're doing, please subscribe to this channel. Please like and comment on the videos. Now, back to the subject at hand. Are you prepared for RMDs? Number 1, RMDs are not optional. Starting at age 72, the pre-tax money you put away over the course of your career will now be subject to the tax. And the government has a very specific way of calculating that tax, in other words, the amount of the RMD, and I'll get to that in just 1 second. Number 2, the distribution amount is determined by the IRS. So the IRS has this worksheet, and this is how we can determine how much tax you're going to owe. So if you look at line number 1, IRA balance on 12/31, I just threw in the number $500,000. Now the only number that really needs to be researched is a little bit lower. So if we go over here, if you look at the 74, so you can see table 3, uniform lifetime. And if you go from age 70 down to 74, you can see I put a box around some numbers. Age 74 distribution period 23.8. So basically what they're saying is you have 23.8 years to go. If we come back here under the 500,000, you could see I put in the 23.8. If you divide that, it comes out to $21,008. Now, if you go backwards and take $21,008 over $500,000, you're going to get into about the 3.5% range. Number 3, the tax rate depends on your income. Because RMDs are considered ordinary income, this is why we want to do some of the planning to reduce these amounts. The reality is that if we consider a funnel, and let's say at the bottom of the funnel, you have other income from a job, part-time work, investment wages, and other, in a pension, let's say. So what happens when you have to start taking the RMD is it goes right on the top. It goes right on the top, and it forces you higher in that tax rate cylinder. So if you're paying some tax at 10%, some tax at 12%, some tax at 24%, what that RMD can cause you to do is to get near the top or higher, and now we're paying 24%. So this is the reason why we want to be very careful about some of the tax planning we do, because we want to stay as low in the cylinder as possible because it is ordinary income. Number 4, there are massive penalties for not complying. Number 5, if you're charitable, you can reduce your tax liability. Making a qualified charitable distribution can be a good way to make use of your RMDs and lower your tax burden. A QCD, as it's known in the trade, is not considered taxable income as it goes directly to a charity. So the Secure Act changes a little bit, but as long as you're 70 and a half, you can take advantage of this vehicle. Number 6, Roth accounts have no such RMD requirement. So the great thing about Roth accounts is they are exempt. In other words, once you put money in the Roth environment, that money can grow and grow and grow. And under current law, you're never going to pay tax on that ever again. It's also much better in terms of inheritance for money that you leave to your kids because you didn't use. If it's in the Roth account. It's going to give them a lot greater flexibility in how they take that money out. So this is another reason why Roth accounts are so positive. Number 7, there are strategies for reducing RMDs and the resulting taxes. Yes, there are ways to reduce your RMDs and thus your future tax liability. So as part of this video, I have included about 1 minute and 42 seconds of an animated video I recorded not long ago to share the bucketing strategy. In other words, and it'll get more into this in the video, each of your assets can go into an individual bucket. And to the extent that you have the ideal amount of money in each of these buckets, you're going to save money on taxation in the future. So give this a watch and I'll come back after. You may remember the grand prize game from the Bozo Show. There were 6 buckets lined up in a row, one lucky child from the audience. Get the ball in the first bucket and win a small prize. Get the ball in bucket 3 and you went home with some goodies. I like to play with buckets as well, but in this case, I'm not clowning around. See, every asset you own, every dollar you have resides in a series of financial buckets. These buckets determine future tax treatment, and there's a mathematically ideal amount of money you should have in each bucket to maximize your ability to save taxes. Bucket 1. CDs, money market accounts, brokerage accounts, savings accounts, even assets invested in real estate live in Bucket 1. Bucket 2. Tax-deferred accounts such as 401ks, IRAs, SEP IRAs, 403b accounts. Most of America has the bulk of their money in this bucket. These assets are the most susceptible to a future higher taxes because this money has never been taxed, and distributions are taxed as ordinary income. Bucket 3. Roth IRAs, and if your employer offers one, a Roth 401k. As you know, not everyone is eligible to make a Roth contribution. You have to be working and earning under a certain income level. Roth accounts are nice, but not particularly helpful for affluent people. Bucket 4 contains properly structured cash value life insurance, which is the only 100% tax-free investment. No federal tax, no state tax, no capital gains tax. So that's a little bit about the bucket strategy. So you can see what we're trying to do. We're trying to move from buckets 1 and 2, taxable and tax-deferred, into the Roth and or life insurance buckets. We're trying to go, I feel like a weatherman, we're trying to go over to where we'll pay less tax in the future and RMDs will be less affected. So a little bit of review. RMDs are not optional. The distribution amount is determined by IRS tables. The tax rate depends on your income. There are massive penalties for not complying. If you are charitable, you can help reduce your tax bill. Roth accounts are exempt. In other words, money can grow forever. It's actually a very, very good vehicle. And last but not least, there are many ways to reduce the amount of taxation you'll pay on your RMDs. And this brings us to the end of our video. 7 must-know, must-understand facets of the complex and easily misunderstood RMD distribution process. I had to take a breath just to say that. I am Daryl Rosen. Thank you for watching. I've created these videos, this resource, for people who want to enjoy safety, simplicity, and strength. In the future, if you need help with anything money-related, retirement-related, tax-related, please feel free to reach out.